the Fed is laser focused on getting rid of inflation and that it doesn't care about any collateral damage. It's not worried about the economy because it thinks the economy is super strong. We have a red hot labor market, and so it's impervious to any rate hikes. And Powell has said repeatedly, the Fed no longer cares about the stock market. It doesn't matter to the Fed what happens to the stock market. It's not going to stop hiking rates simply because the stock market is going down. It's going to focus on vanquishing the inflation threat, and the stock market be damned. And given that attitude, why isn't the stock market imploding even faster? Think about it, because for all these years, investors have operated with the protection of the put. It started with Greenspan. The Greenspan put, he originated the concept of whenever the markets are in trouble, the Fed is there to bail you out. And then that baton was passed along to Bernanke, and Bernanke passed it to Yellen. And for a while, Powell had that, but now all of a sudden, no, it's gone. We've thrown that put away. It's expired, worthless. And so now investors are basically on an investment high wire without a net, because in the past, they were up on this high wire, but they knew there was a net. So even if they fell, no big deal. They would just bounce around in the net and then just get right back up on that high wire and do more tricks. But now that they realize that the net is gone, and if they fall, they're going to fall to their deaths, it should be very scary up on that high wire. Investors should want to climb down off that high wire, because even though the markets have gone down, they're still up in the stratosphere. There is tremendous risk. Remember, everybody is relying on the strength of the labor market to keep us out of recession, including the Fed. Well, the labor market is going to implode. It's not going to be long before the pink slips start going in the mail. I mean, look at what's happening in the stock market. Look at what this is going to do to employment. I talked on the last podcast about the collapse in consumer sentiment. It's an all-time record low, and that was before what just happened today. And so I'm sure consumers are going to be even more pessimistic as they're watching their stock market wealth evaporate. How long before people see their home equity evaporate? What's going to happen to mortgage rates? Consumers are getting clobbered. They are going to have to hunker down. Businesses are going to have to hunker down. This is going to be a massive recession. And given that, is the Fed really going to continue to fight inflation, even though it can't do it without causing a recession? In fact, I think they've already caused a recession. Just like I've been saying, we were in a bear market. We didn't officially get confirmation of that bear market until today. I think that we've been in a recession ever since the beginning of last quarter. We're just not going to get confirmation of that recession until we get the negative GDP number for the second quarter. But the question isn't, can the Fed fight inflation without causing a recession? Because they've already caused it and they've barely begun the fight. The question is, can they fight inflation without causing a depression, without causing a financial crisis, without causing the U.S. government to default on its treasury debt? And I think the answer to those questions are no, it can't, which is why it won't. But the markets still haven't been able to figure that out. You know, to me, if investors played chess the way they invest, they would lose every game. Because for some reason, investors can't see beyond the move that's right in front of them. So their opponent makes a move, and that's it. They can't think about what their opponent may be thinking about 2 or 3 or 4 moves later, and they don't even plan their moves in advance. They just think about one move, how are they going to respond to the most recent move, and that's it. And if you play chess like that, well, you're going to lose every chess game. You got to try to anticipate what's going to happen next. Not only what you're going to do next, but what your opponent might do next, and all the various permutations based on what you might do and what your opponent might do. Obviously, the markets know the Fed is going to hike rates. They're saying that, but they're not seeing what comes next. What do those rate hikes do to the economy? And then how does that change the moves that the Fed makes? Because if investors could see the later moves that are coming, they would be buying gold, not selling it. They would be dumping the dollar, not buying it, but they did the opposite because investors still don't get it. They still believe the Federal Reserve is going to be successful in its war against inflation. But in order for the Fed to actually be successful, the Fed is going to have to raise rates much more than the market believes, and it's going to do far more damage to the economy. It's going to cause, again, not a recession, but a depression. You're going to have a wave of stock market bankruptcies. You're going to have a wave of defaults. You're going to have a financial crisis much greater than anything in 2008 with no bailouts, no stimulus, and included in the defaults will be the U.S. Treasuries. The U.S. government will not be able to pay the interest on the national debt if the Federal Reserve actually raises interest rates sufficiently to bring inflation back down to 2%, which is what they're claiming they're going to do.